Hey fools, busy earnings week for energy materials companies. Joel and I are going to walk you through that, so check us out on Digging for Value. So Joel, we want to start right off at the top with two of the biggest companies in the industry. Big Oil has had a tough run of it over the last year or two with high expenditures and not quite the production you've seen. So walk us through BP and Exxon.
Yeah, definitely. We saw BP have earnings a couple days ago. They obviously missed estimates. Exxon on Thursday obviously came out and also missed estimates. The big story for them was earnings really dropped for Exxon, about 57% year over year drop. If you back out a $7.5 billion one-time item, obviously that improves what the actual outlook was. They're still down 19%, which obviously hurts. And then when you look at BP, really their production was not bad, but with that company, what you have to focus on is their crude oil production. When you look at the actual prices they were getting, they were down. The dollar was also strong, which hurt them, and they had a higher effective tax rate. So that's really what caused them to miss their earnings.
Now, when you look at these two companies, they cover the whole gamut of energy production all the way down through refining. So how do these individual segments perform for them?
Yeah, definitely. When you look at these sectors or these companies, basically everybody thinks of the upstream segment. And really, if you look at the upstream, they both did well. Exxon was down a little bit on production. A lot of that had to do with some of the OPEC issues that they have, basically having to pull back on some of their production. When you look at BP, they were also pretty similar. The production was not bad. A lot of their losses were from acquisitions they've had this year and a lot of acquisitions they've had since Macondo, basically. However, with Exxon, the big drop there was refining. And if you look at the United States refining sector, it's been crushed because of the WTI price. The same thing happened with Exxon. They basically had a $950 million earnings miss or decrease year over year because of the refining sector.
Okay, now to focus a little bit more on just one of them. BP has had a tough run since 2010 with Macondo, finally starting to shake a little bit of that off. They've had a lot of asset sales. So where do you see this company right now?
Yeah, definitely. When you talk about BP, this is really the biggest issue. Everybody's wondering how much they're paying, when is it going to end? And cumulatively, so far since Macondo, they basically have spent over $42 billion. They still have that big trust, $20 billion in it, and they still have about $8.2 billion retained for future payments. So when you look at that, you want to look at what's happening. This last quarter, they had about $300 million payment. So obviously that takes a little bit out of it. But the court case is going through. Right now, there's the first phase is basically through court is with the jury. So really what people are wondering is how that's going, how the market will react once the verdict comes out from there. And then you look at the next phase, which really is the factors against the Clean Water Act. That basically will come through in 2014. So, you'll see if the penalties stay under that $8.2 billion mark. Obviously, that's huge for investors, but a lot of people are thinking it's going to be significantly higher. Originally, about 6 months ago, they were thinking, maybe it could be in that $8 to $10 billion range, but now that more cases keep coming out, that could be pushed up even further.
They've also been trying to strong arm a lot of these people, the claimants that are looking for money, thinking that they might actually be charging undue claims against the company. So we'll continue to watch that. With all that risk, do you see an upside that can really compensate for that, or are you choosing ExxonMobil between these two?
Both of them are pretty safe plays. They're still big oil companies. And, if you look at Exxon, this is a company that you do like because they have a long history of having over 100% of reserve replacement, which is obviously big in this area. They've also returned over $150 billion in the last few years to shareholders, which is obviously very nice. But when you look at them, their capital expenditure budget is getting extremely expensive. They originally were looking at $37 to $39 billion this year. This quarter alone, they spent over $10 billion in capital expenditures, so that's worrisome. And then their dividend really isn't at the level that you can get from a lot of the other integrated majors. They're about a 2.7% dividend. BP, on the other hand, is about a 5% dividend, which is very nice. They also have capital expenditures that are lower. They're looking for the foreseeable future to be in that $24 to $27 billion range, which is a lot lower than Exxon, Chevron, and even Shell, which is $31 billion this year. So, when you look at them, obviously the litigation's a huge thing, but that dividend is nice, and they're really selling a lot of assets. They're becoming a lean company, and by doing that, they can actually start focusing on areas where they can increase the rate of return, which would be very nice for them.
I certainly think so. So mark it down on your watch list, fools. He chose BP today, August 1st. We'll see how it does compared to Exxon. Moving on to one of Exxon's largest competitors in the natural gas space, Chesapeake. We've loved talking about this company over the last year or so. Big changes over the last 2 quarters, and they kind of blew it out of the water. So tell us about what you experienced reading over that transcript.
Yeah, definitely. They had a great quarter. Their adjusted earnings per share came in at 51 cents. Analysts were estimating 41 cents, so obviously very solid.
Yep.
What we really like is production growth was very good this last quarter, and they really haven't, their operating cash flows is something that's been very worrisome. And if you look at their EBITDA, or adjusted EBITDA, it was up 77% year over year, obviously very nice. And adjusted earnings growth of 750%. Fantastic. And then you're just seeing more of a conservative approach from this company. Operating cash flows, which is very important, was up 53% year over year at $1.375 billion, which is very nice, especially when they're decreasing costs.
And one thing that this company really wanted to focus on to kind of alleviate themselves from low natural gas prices was focus more heavily on liquids. So how exactly did they operate in that segment?
Yeah, definitely. By cutting costs, they were focusing on liquids and basically putting a lot of their capital expenditures, I think 85% of their capital expenditures, towards liquids. So you would think that you would see liquids growth and then see production growth drop off overall. You didn't really see that. You saw 7% total production growth, and then you look at the liquids. The daily oil growth was up 44%, and then year over year, 12% sequentially, which is very nice. And they're getting a lot of this from the Eagle Ford. They were early on acquirers of this area, and this has been a fantastic play for them. Their Eagle Ford liquids production is up 135%, or production is up 135% year over year, which is very good. This is a great play for them that they can have a big future in, and they can get low-cost oil from it. And then also their other big oil play in the greater Anadarko Basin, 43% year over year growth out of there. So you're seeing very nice liquids and especially oil growth from the company.
Tremendous numbers for this company that was predominantly natural gas just a few years ago, finally refocusing itself on profitable plays because of a high debt load and high cost. So why don't you talk to us about how they've really been able to attack that?
Yeah, definitely. They really went out and focused on lowering those costs. And this quarter alone, their drilling and completion costs came in at about $1.6 billion, which is very strong. And overall this year, they're looking to, going into the year, they're looking to lower their capital expenditures by over 40%. Year to date, the capital expenditures are down 48%, so they're doing better than they originally thought, which is obviously very solid. And then, the asset sales, they were hoping to get $3 to $7 billion. They put $2.4 billion asset sales in the first half of the year. Recently, they've done about 1.3, so they're looking pretty solid there. And if you look at their actually drilling costs, their production expenses are down 20%, so they're becoming more efficient. Their general and administrative expenses are down 36%, so they're really focusing on costs and increasing that production, which is a very nice mix for them.
So moving on from these producers, they've actually done very well in Chesapeake. We're moving on to refiners who showed the volatility of the nature of the refining industry. As you saw, awesome 2012, not so great start to 2013. So what happened to profits in this sector?
Yeah, definitely. Everybody's expecting the profits for every United States refiner to really go down, and that's really because the WTI price, with the cheap feedstock over the last 2 years, what's really helped the companies do so well. A lot of people increased their capacity to take in a lot of that WTI oil. Now that the difference is only $4, where it was $18 to $20 in the last few years, that's really hurt them. You've seen a lot of pipelines open up that really relieving the amount of oil that was in Cushing, bringing some of the oil down to the Gulf Coast where a lot of the oil refining is. So that's really what's pressuring and compressing a lot of the margins in the space.
So probably a good judge of how this industry is doing is 2 companies that were recently spun off over the last year. You have Marathon Petroleum and Phillips 66, both reporting. How'd they do?
Yeah, well, they actually, Phillips 66 came out and missed earnings. They missed it pretty bad. They basically came in at $1.50 per adjusted EPS. Analysts were looking at $1.83. Marathon Petroleum was pretty much flat. However, when you look at these companies, I think the market was pretty much expecting this. If you look at the actual refining, the income from refining, they were down significantly. You're looking at $632 million in earnings lost in just the refining sector itself from Marathon Petroleum. So, that really hurt them. But going forward, I think they've done a nice job over the last few years to kind of insulate them, these companies specifically. So I'm pretty sure, I'm expecting that the market was already onto this. They already knew this was happening. So it wasn't that big of a deal when they saw these numbers come out.
Okay, so now basically that's a lot of short-term negativity on these stocks after a strong 2012. But here at the Motley Fool, we're long-term investors. So what do you like about this sector over 5 to the next 10 years?
Yeah, definitely. What I like about these two companies specifically over the last 2 years when the money was coming in, they had very great years. You know, they went out and rewarded shareholders. They bought back a lot of shares, increased their dividend, and then they also went out and Phillips 66 for one, split off their midstream assets so they can lower that cost of capital. So now you have the Phillips 66 Partners, which had a very pretty solid quarter itself. And then what also this company, Phillips 66, has done is put a lot of money into their chemicals business. They have 50-50 venture with Chevron, and that's been one of the better chemical businesses out there. They've had phenomenal returns from that company. So that's a nice business to have and grow on if the traditional refining industry has that compressed margins like you would imagine it would. Also, what these two companies have done is really decrease the amount of WTI oil that they needed, and they've been expanding the heavy oils. I think Phillips 66 is somewhere around 35% heavy oil, and Marathon Petroleum is even bigger. They have that new addition of the Detroit refinery, heavy refinery, where they expanded the capacity. So the heavy oil is still at a deep discount where they can get that cheap feedstock over the long term, and Marathon Petroleum is really protected in that area. Even if Keystone doesn't come on, they can still access that Canadian oil sands. Yeah. So that's a very nice move for them.
Yeah, long-term fundamentals do bode very well for these two companies. And moving from the end of the cycle to the beginning, we have National Oilwell Varco, a Fool favorite here, very popular among integrated oil companies for what they can do both on land and offshore at the well site. So exactly how did this company do in a pretty bittersweet quarter?
Yeah, definitely. If you just looked at their press release, you'd think that they'd had a great quarter. You know, their adjusted earnings per share were right on line at $1.33, and they had actually a very strong top line growth this year.
Yep.
The revenues came in, or this quarter, the revenues came in at $5.6 billion, 18% year over year growth. Very nice. They're at a record backlog of $13.95 billion. And then their best segment, their biggest segment, is their rig technology, and they had the second best quarter ever in sales.
Yeah.
So you think that, you know, with seeing that they had a really great quarter.
Yeah, unfortunately, the income statement doesn't stop at the top line, so I think a lot of that had to do with how they got to their earnings. So what exactly did hold them back?
Yeah, definitely. When you talk about what happened to them, it was all about margin compression. And we talked about rig technology, which is over 50% of their revenue. Their basically margins this quarter were at 14.7% year over year.
Yep.
Or last year at this same quarter, they're at 19%, so that obviously hurts. Then you get into their second biggest segment, that's over 25% of their revenue, the petroleum services and supply. Margins also were compressed about 5 percentage points there, so obviously that hurts pretty bad. But when you really look at it, a lot of the compression was pretty short term. There's a lot of contracts that were coming online, a lot of oil companies needing these projects, so they had to increase the labor that they had, turn around a lot of the project timing on it. So they really increased in the short term to make these, fill these orders and ship them out. So over the long term, they still have a lot of projects coming on. You know, this is a company that traditionally has been very good at bolt-on acquisitions. So they're figuring that out so they can get the supplies to the customers in a timely manner going forward. So this I really see as just a short-term little blip for the margin compression.
Yeah, it certainly seems like, you know, having to please your customers and having margins contract a little bit from that, you could have worse problems in the world. Margins could contract for something that's happening internally, which isn't the case with this company. Yep. Okay, so now that we've gone over what held them back this quarter, what's there to get excited about with this company?
Yeah, what I really like is really the offshore market, and this is a company that obviously goes out and supplies a lot to that industry. Yep. And if you look at a lot of their customers, you know, companies like Seadrill and Ansco, there's a lot of the offshore drillers are really going out and buying a lot of rigs because the demand's there. Obviously, people are wanting those new types of rigs, which helps National Oilwell Varco out because they can go and supply that. So obviously, very nice. And if you look at the floaters and jackup market, it's been very nice for them. I think they had about $3 billion in new orders this last quarter, and they had 7 drill ships come on, and I think about 12 jackups. So obviously, very, very solid. And then also, what I like about them, what I think the market is discounting them, but I see this could be a nice boon for them, is North American market. Obviously, if you look at Halliburton and a lot of the fracking, people are expecting flat revenue for North America for the foreseeable future. Yeah. They're thinking the same thing for National Oilwell Varco. But when you look at this company, they're looking at the supply levels, and a lot of their customers are actually depleting a lot of that. So they actually see in the next year this market to start picking up, which isn't really expected. So with a lot of the supplies that they have, and really increase in tier 1 type rigs, online rigs, they see that North America actually could be a little bit of a boon for them as well.
Okay, so now what's your outlook? Boilerplate question, what do you see from this company going forward?
Yeah, definitely. We talked about the margins, which set them back, and the market discounted them slightly because of that. I see that as very short term, and obviously they have a strong business going forward. We mentioned also the bolt-on acquisitions. Last year, 2012, they had $5.3 billion in acquisitions, and they acquired about 20 firms. So what they do is get the firms small, really integrate them into the process, and become the best player in that field, which is very solid. And then lastly, for shareholders, they doubled their dividend this last quarter, so that's obviously
Can't complain
very
about
solid.
that, yeah. So now moving back onto the deep water segment where National Oil of Arco really caters to, I'm looking at that segment as a very strong segment moving forward. You saw Ensco report record quarter for both earnings and revenue. You saw all their earnings growth really come from their deep water segment, not so much from their jackups, even though they did see day rates rise in that segment. You saw Hercules, who's permanently jackup rigs right now, slightly moving international, but mainly in the Gulf of Mexico. They saw day rates up 39% for the jackup market. Ensco saw day rates up 18% as a whole. And so you saw that kind of flow through the entire segment. But Ensco, I think, did better than a lot of its peers. You saw Diamond Offshore missed out on earnings due to some tax reasons, but operating profit before tax was up 4%. Versus Ensco, which was nearly 9% there, just over 8%. So obviously a little bit more market share gain from Ensco. And then you move on to plenty of new ships coming online, but day rates still rising. I mentioned the 39% increase for jackups at Hercules. You saw Noble Corp only up 5% year over year because drill ships did pull back about 4.5% to 5% on the day rates. So Ensco really seeing a lot of great things here. The peers are as well, but I think Ensco a little bit more so.
Yeah, definitely. Ensco, I think, is one of those companies that has that newer fleet, and all their customers think that they have the #1 satisfaction rating. So obviously, very nice company. However, when you look at a lot of these companies going out and buying buying a lot of drill ships and a lot of submersibles, do you think that they've bought too many? Is the demand really that strong?
Yeah, I think so, and a lot of other people in the industry do too. You see a Woods Mackenzie study thinks that spending in the deep water segment is going to be up 3x just by 2022. So in just a few short years from now, triple the spending that you're seeing currently, which is quite a lot considering what companies in the integrated side are already spending off the coast of pretty much every country in the world. And they think that 95 new rigs will be needed by 2022 to accommodate that. So what you're seeing from a lot of these companies, you see Ensco with 8 coming off the shelf over the next few years. You see Diamond Offshore with 7 deep water and ultra deep water ships. They're all contracted. You look at Noble Corp's ultra deep water ships coming off the line, all of them are contracted, and right now day rates are rising. So the demand is there. It just depends on how quickly these shipyards can get them on water and servicing these wells.
Yeah, definitely. The next segment that you want to look at is basically the natural gas liquids. The prices in the United States have been compressed because that's a byproduct when you drill for oil and natural gas. However, this has helped a lot of chemical companies. So what do you see going on here?
Well, basically you're looking at ethane being a pretty prominent feedstock in cracking. They produce ethylene, which then gets translated into a whole host of products, all the way from car tires, automotive parts, to plant nutrients, and even plastic bottles that you see every day. It's around half the price that it was in the first half of 2012. So companies domestically that are using this ethane to ethylene cracking process here are enjoying a wider margin than their international peers who have been forced to use an oil-based naphtha, which right now is about twice the price. And it also includes a little bit higher cost structure because it does take a little bit longer to crack. So you're seeing North American producers of these chemicals like Dow and Westlake really thriving. Dow Chemicals came out saying that their performance chemicals market really boosted company margins way more widely than they would have if this segment hadn't had this ethane advantage. And then Westlake as well. You just see wild growth here from them quarter over quarter just due to ethane. They show ethane prices down 24% year over year in the second quarter. So that's helping their cost structure tremendously.
Yeah, definitely. When you look at the chemical companies, obviously they're being helped out by the low prices. The producers, on the other hand, are starting to cut production because if their money's not there, they're going to stop producing it. So what do you see on the supply and demand axis here? Because that's really what's important over the long term for investors.
Yeah, well, when you're looking at what's happening here, supply and demand, you're seeing a lot of ethane rejection from the producers and the midstream companies that are separating this out from natural gas. They're just leaving it in the pipeline. It's not economically viable for them to process this out and sell it to the Dows and the Westlakes of the world. So they're just leaving it there. Production's down about 9% over the first 4 months of this year versus 2012. So you're already seeing this have its effects. Dow Chemical is supposedly trying to build just a number of facilities down on the Gulf Coast. They even estimate that over $100 billion in planned facility building will take place over the next few years. So that's going to help from the demand side. And then on the supply side, you have Spectra Energy and Enterprise Product Partners both building midstream assets in order to get these natural gas liquids from the Marcellus and Utica region down to the Gulf Coast because of this increased demand that you're probably going to start seeing in 2015 and beyond. So I think finally these producers are going to have an end user domestically to then send this ethane to, because right now they're just too much coming out of the ground for Dow and its competitors to keep up.
Yeah, definitely. And next, what you want to look at is basically the United States overall, and looking at a number of different energy sources. And you really see this this area, the United States, has a lot of growth ahead of it. So what are you looking at?
Yeah, I mean, I've looked at the earnings over the past few weeks, and I've noticed a few things. You know, one from each segment. You got oil, a lot of bottlenecks due to pipeline constraints. Natural gas, the producers are being handcuffed again. We thought in April we were going to see a lot more production coming out of these companies as far as dry gas is concerned, but the prices plummeted since then, and they're now back down below $4, around $3.40 to $3.50 from that $4.18 high in April. So the producers there are really struggling. And then with natural gas liquids, a lot of the same thing, low prices because the demand just hasn't kept up. So I'm seeing natural gas and natural gas liquids producers really struggling because of that.
Definitely. What do you see going forward? Do you see things changing here?
I do, and not from the pipeline and oil standpoint. Rail is really taking over the near to midterm. I'd say over the next 4 to 5 years, this growth that we've seen in rail, I believe it's around 166% growth from the first quarter of 2013 over 2012 as far as rail shipments in the United States for oil. Canada's seeing a lot of the same things. So I'm looking at companies like Canadian Pacific and Canadian National Railway to really take advantage of this because they do have that close proximity to the Bakken, and the refiners on the east and west coast are looking for this oil that pipelines just can't get to them. You see TransCanada announcing that they're going to move forward with their eastern-bound pipeline, but that's not going to come online until 2017. So what are companies going to do in the meantime? Rely on rail. And then moving on to natural gas, what's going to help them? 2015, the first export facility comes online with LNG Cheniere down in Sabine Pass. You saw another facility get approved, and we saw Ernest Moniz, the Secretary of Energy, speak not too long ago, saying that he wants to expedite this process, but in a judicious fashion. So I look for Dominion Power in their export facility to probably be approved off the East Coast, add a little bit of geographic diversity here. So exports are really going to help buoy that natural gas price and get producers pumping it out of the ground again. And then with natural gas liquids, you're still seeing producers suffer. You saw both One Oak Partners and Chesapeake state this as a headwind with ethane rejection. Their earnings would have been even a lot higher than they were had this not happened. So once a lot more demand centers come on around the Mount Belvieu and Texas Panhandle, I see all three of these sectors really booming over the next 5 years as the United States just got ahead of itself, I think, in its production capabilities.
Well, yeah, I definitely agree with you. Thanks a lot for your insight. And thanks a lot for tuning in. Be sure to tune back in next week for more Digging for Value.